I want to share with you 5 ways to reduce your debt to income ratio. And maybe the question is why? Why do I need to reduce my debt to income ratio? The answer is because home prices are getting more expensive, interest rates are going up, and you want to be able to afford as much home as possible. Now, you might not push yourself and buy a home at the tippy top, but you want to at least have your options open. So I want to share 5 ways that you can reduce your debt to income ratio. The first one is your current debts. So there's a couple things that you can do here. You can call up your debtor and you can extend the terms. You might have to refinance that debt in order to do that. You can consolidate your debts or pay them off. So there are ways to manage your current debts to get your monthly debt load lower. The other side of the coin is your income. There are things that you can do to raise your income. Maybe you get overtime, but you've only been on the job 6 months. We need you to be on the job at least a year to use variable pay, like overtime or bonuses. And if those little bits add up to a lot, we want to make sure to give you credit for that. So being on the job a minimum of a year to get access to your overtime and your bonuses and variable pay could make a big difference. You also could pick up a gig job, right? What's that second job? Could you start driving for Uber, or could you pick up a service job? Could you do something on the side? Well, you'll need to do that side job for a minimum of 1 year. The standard is 2, but with an exception, we can get 1. So how can you increase your income? Another thing to think about is repairing your credit. Well, you're like, well, that doesn't exactly relate, but it does. Because if you have a higher credit score, you'll have a lower interest rate. And a lower interest rate will help you with that monthly payment, making it lower, allowing you to afford more. So make sure your credit is optimized. If you don't know, get your credit report pulled, know what your score is going in, and then we can put you through credit optimization and then increase your score. Another idea is to manage your homeowner's insurance. A monthly payment is made up of PITIA. That's principal and insurance, taxes, and interest. And then the A is for HOA bills. Well, your taxes you don't control. Regretfully, I wish we did. But that property tax is set by the county. And the principal and interest is determined by the interest rate and the amount of your loan. But that homeowner's insurance, you can adjust depending on who you choose as your agent, what company you use, your deductibles, what coverage you have, so you can manage your homeowner's insurance, dropping that monthly payment. The last part, the number 5, is your mortgage insurance. If you're putting less than 20% down, more than likely, not always, but more than likely you have mortgage insurance. Well, you can do an upfront mortgage insurance, reducing your monthly payment. So you should look at the options, especially if you're putting 20% down. We've actually found that buyers with less than 20% down have slightly better interest rates. Why? Because lenders like mortgage insurance. So if you're planning on putting 20% down, you might just find that putting 19% down might give you a better interest rate, and that upfront mortgage insurance could be less than that last 1% down. So this is all about options. How do we increase your affordability by decreasing your debt to income ratio? You want to know more? Then give us a call. Nicole Rueth with the Rueth Team Fairway Mortgage. It's our pleasure to serve you.